Good day or good morning, good afternoon or good evening, depending on where you're watching from and what time you're watching. Today we'll be taking throughput accounting. We'll be using the question from Ican November 2020 question 2. Now the major difference between throughput and marginal costing. The marginal costing will consider all variable costs, while in throughput they consider only direct materials as a variable cost, and every other one that was considered as variable cost under marginal will be treated as fixed. So this question will help us expatiate more on that point. Please help us get through the question, then we'll take the solution.
Ican Nigeria Limited manufactures two products, light and medium, on the same machines. Sales demand for the product exceeds the machine capacity of the company's production department. The potential sales demand in each period is for 10,000 units of light and 15,000 units of medium. Sales prices cannot be increased due to competition from other producers in the market. The maximum machine capacity in the production department is 40,000 hours in each period. The following cost and profitability estimates have been prepared. Light, medium. Sales price for light we have 110, medium we have 135 naira, direct materials 50 naira, medium 45, direct labor and variable overhead, light 30, medium 55, contribution per unit 30, medium 35, machine hours per unit 1.5 hours for light and 2 hours for medium. Fixed costs in each period are 450,000 naira. Required: 1. Using marginal costing principles, calculate the profit maximizing output in each period and the amount of profit. 2. Explain how throughput accounting differs from marginal costing in its approach to maximizing profit. 3. Using throughput accounting, calculate the throughput accounting ratio for light and medium. 4. Using throughput accounting principles, calculate the profit maximizing output in each period and the amount of profit.
Okay, we'll take the solution to that question. For the A, we are asked, using marginal costing principles, calculate the profit maximizing output in each product and the amount of profit. First, we will know that we are limited by hours. We have limits in hours. We are limited to 40,000 hours. We are limited to 40,000 hours. Secondly, we know that the demand or the unit required for light and medium. For light, how many units is required?
10,000 units.
10,000 units. For medium,
We have 15,000 units.
15,000 units. So other information provided shows that for light, for each unit, they are going to use 1.5 hours. For medium, for each unit, they will be using 2 hours. If you calculate how many hours it will be needed to produce these 25,000 units, you will find out that it is more than the 40,000 hours that is available. So we are going to find out how to allocate it in order to use exactly these 40,000 hours and still get the optimal profit using marginal costing. So the first step will be step 1, although it's already written in our question, we'll be calculating just in case we have other questions where it was not done. We'll be doing the contribution per unit. The contribution per unit is simply sales price, then we'll less all other variable costs. So for light, we'll have for light, we'll have for medium. For light, the sales price is what? The The sales price for light, according to what we have here, is 110. The sales price for medium will have 135. There were less other variable costs. They say direct materials. So I have direct materials. We equally have direct labor and variable overhead. Direct labor and variable overhead. So the direct material under lights, we have 50, so less 50 from here. Under medium, we have 45, or less 45. Then under lights for direct labor and variable overhead, we have 30. Then under medium, we have 55. So once we less this, we'll be having the contribution per unit. So that will be contribution per unit. And the contribution per unit will be 100 less 50 less 30.
That's 30.
Will give us 30. Then 135 less 45 less 55.
35.
Will give us 35. So these are their contribution per unit. Then once you have gotten the contribution per unit, we need to get the contribution per machine hour. So we need the contribution per machine hour. I think I will just leave that here. Contribution per machine hour. The contribution per machine hour, we divided the contribution per unit by the machine hours available for that will be needed per unit of each item. So we'll have for light, and we'll have medium. For light, we'll have 30 over 1.5 hour. Then here we'll have 35 over 2 hours. So this will give us.
First one is 20.
20.
The second one is 17.5.
20 and 17.5. 17.5. So these are their contribution per machine hour. We'll rank their contribution per machine hour. So ranking. So we'll know exactly what to produce. The ranking will have this as first because it's higher than this. So this will be first, meaning the light is first, and the medium ranks second, meaning we are producing in that order. So let's get the product mix. This is step 2. Step 2, which is the contribution per machine hour. Step 3 is best product mix. Best product mix. Now for the best product mix, for this we are going to produce the entire amount. We have a demand of what? 10,000 V.
Yes.
So that is for light. Light will have 10,000 units multiplied by what?
1.5.
1.5. That 1.5 is the hour required. It give us what? Total hour. What is the total hour?
15,000 hours.
15,000 hours. That is what is required to produce the entire 10,000 units of light. So what is the balance length? That will be balance. The total is 40,000 hours. So 40,000 hours less the 15,000 hours that we have used for light will give us
25,000
hours. Now, to know the exact quantity we are going to produce for medium, we are going to be dividing the 25,000 hours by the hours is required to produce a particular item for medium. So that will be 25,000 hours divided by 2, which is by 2 hours per unit. That should give us
12,500.
12,500 units. So what it means is we are producing 15,000 units, 10,000 units for light, 10,000 units for light, and 12,500 units for medium. That's what you are going to be producing. So we'll go immediately to step 4, Go to step 4. Now the step 4. Step 4 is the computation of profit. Computation of profit. So we first have this, we are producing 10,000 units. So that will be light. For light will be 10,000 units multiplied by the contribution per unit for light. Contribution per unit for light is what?
30.
30. Then for medium we have 12,500 units as we agreed here. Times the contribution per unit of what?
35.
35. This will give us
300,000.
300,000. Then 12,500 units times 35.
437,500.
437,500. The total of the two gives us total contribution. Total contribution. And the contribution gives us what?
737,500.
737,500. So fixed cost. The fixed cost is what?
450,000.
450,000. Or less that to get our profit. So profit will be
287,000.
287,500. Now that is a solution for the A part, which says using marginal costing principles, calculate the profit maximizing output in each product and the amount of profit. So we'll be moving to profile solution to the B. Okay, for the B part, we'll continue from the B part of the equation and say we should get the difference between the marginal costing and the throughput accounting technique. So for the marginal costing, as we have done prior to this, it considers all variable costs, as you notice when we are computing for profit using marginal costing. Throughput accounting only considers direct material as variable. Then, secondly, marginal costing considers direct labor and overheads as variable, while throughput accounting considers direct labor and overheads as fixed. Thirdly, the marginal costing focus is on contribution per unit as shown in the previous work we did. Then for throughput accounting, focus is on the throughput per bottleneck hour, which we are going to see. Then for marginal costing, in the fourth point, we have aims to maximize contribution. You can see we use the contribution in order to arrive at profit. Why? For throughput accounting, it aims to maximize throughput efficiency. Then, the fifth point we have, for marginal costing, it uses contribution to decide the product mix, just as we previously ranked the contribution for both products. While for throughput accounting, it uses the throughput accounting ratio to rank products. So these are their differences between the marginal costing and the throughput accounting, which is required by the B part of the equation. So we'll be moving to the C part of the equation. So we are going to provide a solution to that. So we're moving to the C part. The C part, what we are asked is this. They said using throughput accounting, calculate the throughput accounting ratio for light and medium. So we'll be computing the throughput accounting ratios, we'll be taking some steps. To get to the throughput accounting ratio, we need to get the throughput per unit, which is step 1. Throughput per So that throughput will have sales price. Sales price will have for light, will have for medium. For light, what's the sales price?
110.
110. For medium?
135.
135. Now, if you recall what we said prior to this, I said for throughput accounting, they only consider direct material as a variable cost. So less direct material. Direct material. For light, the direct material is what?
50.
50. For medium?
45.
45. So once we less this, we'll have what?
60.
We'll have 60. And here?
We have 90.
We'll have 90. So there's a return we'll get per unit. That's what we'll have there. And in step 2. Step 2, we'll bring in the hours that is required. That is the throughput per unit. Throughput per unit, which is you have computed divided by the hours required. Hours required. So the throughput per unit divided by the hours required. For light will be having what?
60.
60 divided by what's the hour required?
1.5 hours.
1.5 hour. Then for medium will have
90.
90 divided by what?
2.
2 hours.
The first one we have 40.
40.
Yes.
45.
45.
So these are in Naira. This is in Naira. This is in Naira. This is 45. So this is throughput per hour. Per hour. So the throughput per hour is what we have. Then we are going forward to compute, as I told us before, that they consider other variable costs such as the direct labor and variable overhead as fixed costs. So we'll be adding them to other fixed costs to get our total cost. Then from there we are going to get the requirement of this C, which is what? They say calculate the throughput accounting ratio. But before we will do that, we need to get the total cost, which is step 3. Step 3, the total cost. For the total cost, we'll be working with direct labor and variable overhead. So direct labor and variable overhead. For light, how many units is required?
10,000 units.
10,000 units. So I have 10,000 units multiplied by what is the direct labor and variable overhead? 30, Abi? 30 for light. Then for medium, what unit is required? 15,000, Abi?
Yes.
Times what's the direct labor and variable overhead? Direct labor and variable overhead.
I think we have
Direct labor for medium, direct labor and variable overhead is 55. So here is 55. So 10,000 times 30 will be giving us what?
300,000.
300,000. 15,000 times 55.
825,000.
825,000. We add these two, we have what?
1,125,000. 125,000.
1,125,000. We'll be adding fixed cost. Add fixed cost. That will give us the total cost. This will give us what? Fixed cost is what?
450,000.
450,000. So the total cost is what?
1,575,000.
575,000. Now we are going to be dividing the total cost by the total hours. So we'll be having total cost per machine hour. Total cost per machine hour. And our total cost is what? 1,575,000. The machine hour is
40,000.
40,000 hours. That is what is available. So this divided by this will give us our total cost per machine hour.
Is equals to 39.375.
39.375. This is the total cost per machine hour. Now, in order to get our ratio, because that's our requirement here, they say using throughput accounting, calculate the throughput accounting ratio for light and medium. So throughput accounting ratio, it will be our step 4. Throughput accounting ratio. For throughput accounting ratio, I will need to wipe here. For throughput accounting ratio, we'll be having what? We have data throughput per hour. Throughput per hour divided by our total cost per machine hour. Total cost per machine hour. So for light and for medium. For light, we have what?
40.
For light, we have 40 divided by the machine total cost per machine hour, which is 39.375. For medium, we have what?
45.
45 divided by 39.375. That will give us what?
For light, 1.02.
1.02 for light.
For medium, 1.14.
1.14. So we have computed the throughput accounting ratio, which is a requirement for C. We can rank this. So the ranking, for ranking you can clearly see the medium is higher. So light will be the second based on ranking. Then medium will be the first. So that is the requirement for C. We'll go to the requirement for D. The requirement for D is using throughput accounting principles. Calculate the profit maximizing output in each period and the amount of profit. That is what they asked. So we'll compute. We have already ranked this as second and first. We'll be going to the product mix, which is step 5. And this is our D. Our D starts here. Step 5. Product mix. For the product mix, They said we are ranking this first, which is our medium. So for the medium, how many units is required for the medium?
15,000 units.
15,000 units. How many hours to make each?
2 hours.
So times 2 hours. You give us what?
30,000 hours.
30,000 hours. Now, we'll have to check the balance because if you recall, we were limited to 40,000 hours. So the balance would be 40,000 hours, 40,000 hours minus 30,000 hours, which will give us 10,000 hours. So this is what we'll have that we can use to produce light. Now to get how many units we can produce out of this for light, we will need to be dividing that 10,000 hours. 10,000 hours divided by how many hours it will take per unit of light?
1.5.
1.5 hours. To give us how many units?
6,667 units.
6,667 units. So what it means is you are producing 6,667 units of what? Light. And you are producing 15,000 units of medium. So step 6 will be to compute for the profit. To compute for the profit, we are producing 15,000 of medium. So medium, 15,000 units of medium times what is the contribution, the throughput as we computed in the very first
90 naira.
90 naira. The throughput we computed was 90 naira. 15,000 times 90 naira for medium. Then for light will have what? 6,667 units times, what's the throughput?
60 naira.
60 naira.
The first one is 1,350,000.
1,350,000.
The second one, 420,000.
20 naira.
Yes.
If you add them, we'll have what?
1,750,000 and 20 naira.
And 20 naira. Now we are going to less the fixed cost, or we call it total cost because we have computed it in this other one. We'll less the total cost. So less total cost. And the total cost is what?
1,575,000.
575,000. That's our total cost. This will now give us a profit, which is what?
175,000
175,000
and 20 naira.
and 20. So this was their requirement for throughput, using throughput principles to compute for the profit. I hope you find this video useful to understand the concept of throughput accounting and for proper preparation of your Ican forthcoming examinations. Thank you very much for your time.